So everybody here, unless you've been living under a rock for the past 2 decades, should know about the stock market, or have at least should have heard about it. But most people don't actually understand how it works. So the stock market works similar to how a product would work in a store. If a consumer wants more of a stock or a company in the market at a given time, then their price will rise and increase. If they want less of it, then their price will decrease. Currently, there are 2 major indices in the United States stock market. They are the NASDAQ and the New York Stock Exchange. The NASDAQ currently has 3,300 companies, and the New York Stock Exchange has about 2,800. The first instance of government involvement in the stock market was during the Great Depression. During the Great Depression, there was a large inflation in the price of stocks. This was caused by banks having little restrictions on what they could lend, and people being able to borrow money to simply reinvest in the stock market. They weren't investing their actual capital, and rather investing borrowed money that wasn't theirs. This led to an inflation of stocks, and eventually the demand for stocks went down because people realized that this was an artificial bubble. This caused Black Tuesday to happen, and after Black Tuesday, the stocks fell until they hit about nearly an 80% total decrease. Now, the government was forced to respond because as the stocks decreased, companies had less money to work with, and unemployment rose to a rate of nearly 25%. They had to pass many laws that restrict banks from being able on restrictions on what they could lend. So after they passed their laws, banks could no longer lend people money if the people were going to invest in the stock market. This prevented another bubble from forming for that reason. However, it didn't prevent all bubbles, as we'll see in the future. Although these changes work primarily to stop the financial markets, it also had effect on the economy as a whole, because in a sense, the stock market is just the economy in organization of companies, because the stock market is made up of nearly 6,000 companies in the current economy. Not all the companies, mind you, but most of the companies. And because of that, when the companies are doing bad and the stock market is down, then the economy will be down, and most likely unemployment will be up, like the Great Depression in this case. Now, another example of the government interfering with the economy is the 2007 to 2009 housing bubble. During this time, the Bush administration before this removed many restrictions that it had against banks. This caused banks to be able to lend to people that were living on minimum wage or might have not even had a job. People were buying houses who were unemployed, and many mortgages were not paid. Mortgages at this time were in bonds, which were rated by many bond rating firms, and the bond rating firms were giving them good ratings despite that they were actually bad. This deceived buyers into buying into them, thinking that they were safe, and when the bonds crashed, everybody crashed with it, and so did the stock market. After this crash, this government had to set more regulations against banks, specifically, and also they had to use some sort of fiscal policy to revive the economy, and they did, as we see from the graph. It started increasing after it hit its low of nearly a 50% decrease. More recently, an example of the government intervening in the stock markets and economy as a whole is President Trump's recent passings of China tariffs. Since this fall, Trump has passed the first set of China tariffs, which were at a rate of 10% on some goods from China. He wanted to do this because China did not want a trade deal with the United States, and he thought by applying tariffs, this would increase the likelihood of a trade deal happening because it would apply pressure on the Chinese economy. However, although this was the case in a sense, it also affected our economy a lot, and it decreased by nearly 20% up until the new year hit, and then it rebounded. However, recently, this May, President Trump decided to increase the tariffs to a rate of 25% on some goods from China. This caused another drop in the stock market, and although there were many other political conditions in the last drop that occurred based on these tariffs, this drop was exclusive to tariffs, and it shows how tariffs and some acts of government involvement in the stock market can be really harmful to the stock market and economy. Another way that the government interferes with the economy is through regulating crime, specifically insider trading in the economy. Insider trading is when somebody gets undisclosed private information from a company before they release it to the public to know about. So for example, if someone was working at a drug company and they were a chemist making drugs for the company to sell, if they knew that the drug was going to pass or was more likely to pass, and they had no doubt in their mind, and they invested in the company's stock, and that stock went up, if they were caught, they could be put in jail because they had information before the public had information. This takes away money from many ordinary consumers who do not have this information and is overall unfair, and it's one of the ways the government can protect consumers from potential downsides that can occur from the stock market. So overall, through doing my research on two major financial events in the US stock market and the economy as a whole, I found that although governments should have some involvement, it should not be at a level to where tariffs are interfering with the economy at such an alarming rate. And if they do use tariffs, they need to be quick so that the economy does not take such a large hit over a large period of time, and so that people's savings are safe, like they should be.